Arena, and we're kicking the year with a new topic. I believe all throughout last year, we have had a couple of topics which have been quite successful for every trader who has joined us in the previous sessions, right from when we started the Guru Trader, the Holiday Trader, and a host of them like that. So today we will be talking about strategies, and they will contain the Elliott wave theory. They will contain zigzag formation and also trading divergences. So these things are important. So Elliott wave theory has been very, very important for traders. So back in the old school days of the around the 1920s and 30s, there were geniuses and professional accountants and also other people, but we the man Ralph Nelson Elliott. He has been analyzing close to 75 years worth of stock data. Elliott discovered that stock markets actually didn't. So when 66 years old, he finally gathered enough evidence to share his discovery with the world, to the wave principle. And according to him, which is a bit predominant psychology of the masses at that time, Elliott furthermore explained that some upward and downward swings in price has caused by the collective psychology always showed up the same repetitive patterns. Now, he called that upward and downward swings waves, and he believes that if you can correctly identify the repeating patterns in prices, you can predict where price will go or not go next. So this is what so appealing 5 precise points where price will most likely up with a system that enables trade prices. Elliott found this Elliott wave theory, which is an awesome one. Of course, like all other mad geniuses, he needed to clean the observation, so he came up with a super original name, which is the Elliott wave theory. But before we move into the Elliott waves, you need to first understand what fractals are, how to get your hand around them, and etc. like that. Next page, please. Now, fractals are structures that can be split into parts, each of which is a very similar copy of the whole package. because mathematicians like to call this properly self-similarity, and you don't need to go far to find examples of fractals. They can find all over nature, and a seashell is a fractal, a snowflake is a fractal, a cloud is a fractal, heck, a lightning bolt also a fractal. So why are fractals important? One important quality of Elliott waves is that they are fractals. Much like seashells and snowflakes, Elliott waves could be further subdivided into smaller Elliott waves, ready to be an Elliottician noun. Now, we have, for example, you take a look at a 5-wave impulse pattern, as you can see here. It still holds kind of confusing, but let's just put a little color on it on the other one as we see. You can see magnificent, a very important and very color-coded zigzag pattern. Now we're going to use, for example, stocks, for example, and since stocks are what Mr. Elliott used in trading, it really doesn't matter what it is. It can easily be currencies, bonds, gold, oil, or any other thing. But the important thing is that the Elliott wave theory can also be applied to the foreign exchange market, which of course is the largest financial market, boasting of $6.6 trillion trading volume every day. Now, for wave one, the stock makes its original initial move upwards. This is usually caused by a relatively small number of people that all of a sudden feel that the price of the stock is cheap. So it's a perfect time to buy. This causes the price to rise. And at this point, enough people who were in the original wave consider the stock overvalued and take profits. This causes the stock to go down. However, the stock will not make to its previous lows before the stock is considered to bargain again. Next page, please. So for wave three on the momentarily, we can say this is usually the longest and the strongest wave, because after wave one, wave two, the stock has caught the attention of the mass public. More people find out about the stock and want to buy it, and this causes the stock's price to go higher and higher, and this wave usually exceeds the high created at the end of the wave one. Then for wave four, we have traders take profits because the stock is considered expensive again, and this wave tends to be weak because there are usually more people that are still bullish on the stock and are waiting to buy on the dips. While for wave five, this is the point that most people get on the stock, and it's most driven by hysteria. You usually start seeing the CEO of the company on the front page of major magazines as the person of the year, while traders and investors start, coming up with ridiculous reasons to buy the stock and try to, choke you when you disagree with them. So this is when the stock becomes the most overpriced, while contrarians and start shorting the stock, which starts the ABC pattern, right? Similarly, we have impulse waves. So according to Elliott, it usually, you also need to understand theory. Elliott wave theory is that one of the three impulse waves, 1, 3, or 5, will always be extended, simply because there always be one wave there is no longer than there is no longer than the other. It is usually the 5th time went by, and this old school style of wave labeling has changed because more and more people started labeling the 3rd wave as the extended one. So we're speaking of also what we call corrective waves. Now, corrective waves, as the name implies, have come when there is a change in pattern. The 5-wave trends are then corrected and reversed by a 3-wave counter trend, and letters are used instead of numbers to track the correction. Why when you're checking out some example for smoking hot corrective 3-wave pattern, just because we have been using a bull market as many primary example doesn't mean that the Elliott wave theory doesn't work on bear markets, because the same 5 to 3 wave pattern can look a bit like this. We see a downward trend, and then we see a push up, a pullback, and a fire back on the C trend line, which is to push it up to a new or reversal, a complete reversal of the trend. Next page, please. So we have types of corrective wave patterns. So according to Elliott, there are 21 corrective ABC patterns ranging from simple to complex. And the basics of the Elliott wave theory are already mind-blowing. So the great thing about Elliott wave is you don't have to be above the legal drinking age to trade it. You don't have to get a fake ID or memorize all 21 types of corrective ABC patterns, because they are just made up of 3 very simple, easy to understand formations. So let's take a look at these 3 formations. The example below apply to uptrends, but you can just invert them if you're dealing with a downtrend. Now we have zigzag formations. You have sideways, up, down, sideways, and finally back up. The zigzag formation are very slick moves in price that goes against the predominant trend. So wave B is typically shortest in length compared to waves A and C, as you can see. And these zigzag patterns can happen twice, even thrice in a correction, right? So 2 to 3 zigzag patterns linked together, like with all waves, each of the waves in zigzag patterns could be broken up into 5 waves, as the case may be. And we talk about also flat formation. Now, this is more like a W pattern, a complete W pattern. Flat formations are simply sideways corrective waves in flats. The length of the waves are generally equal in length, with wave B reversing wave A's move and wave C undoing wave B's move. And we say generated because wave B can sometimes go beyond the beginning of wave A, as you can see from the diagram above. So you see wave A coming down, B pushing back up flat immediately, same on the resistance. And right there, same on the resistance, we have B falling flat to C, and then skyrocketing again back to where it was at the top. Next page, please. Right. Now, importantly, we have what we call triangle formation. Now, let's take, for instance, when a trend, this obviously looks like something like a trend, and up, down, up, down, up, down, but all are happening in a symmetrical patterns that are bound by either converging or diverging trend lines. Triangles are made up of 5 waves that move against the trend in a sideways fashion, and these triangles can be symmetrical, descending, ascending, or expanding. So we can say drop by our forums if you want to, or you can do like we mentioned earlier, Elliott waves are fractals. Each wave is made of subwaves, and you know, pictures are great, and you can understand that wave 1, 3, 5 are made up of a smaller 5-wave impulse pattern, while waves 2 and 4 are made up of smaller 3-wave corrective pattern. Always remember that each wave is comprised of similar wave patterns, and these patterns always repeat itself forever. To make it easy to label these waves, the Elliott wave theory has assigned a series of categories to the waves in order of the largest to the smallest. They are one grand supercycle, which is multi-century. They are supercycle about 40 to 70 years, 1 year to several years, and a few months to a couple of years, intermediate, weeks to months, weeks, days, hours, minutes, and a grand supercycle is made up of supercycle waves, which is made up of cycle waves, which is made up of primary waves, and of course, which is made up of intermediate waves, which is made up of minor waves, and also made up of minute waves, which is made up of minute waves, which is also made up of sub-minute waves. It's a really diff thing to get, but I'll go by it again. We have the grand supercycle, also called multi-century. We have the supercycle, about 40 to 70 years, easy. We have cycle, which is 1 year to several years. We have primary, a few months to a couple of years. We have the intermediate, which is weeks to months. And then we have minor, we have minute days, we have minute, which is hours. And we have sub-minute, which is minutes. So, which is made up of sub-minute waves. And it's just for you to get a hang of how each waveforms, understand the cycles, how they move, how they form, and you're able to replicate this to profitability once you identify them on the chart. Next page, please. Okay, to make things clearer, as you can see, waves aren't shaped perfectly in real life. You also learn it's sometimes difficult to label waves, but the more you stare at the chart, the better you get. Besides, we are not going to let you go all by it all alone, because in the following sections, we'll give you some tips on how to correctly, easily identify waves, as well as teach you how to trade using Elliott waves. Now, there are three cardinal rules of the Elliott wave theory. Wave 2 can never go beyond the start of wave 1. Wave 3 can never be the shortest impulsive wave. And wave 4 can never cross into the same price area as wave 1. So you should just pick this up, and these important points. You should just pick these important points and take them with you as an eye opener when you are spotting Elliott waves. So 1, wave 2 can never go beyond the start of wave 1. Wave 3 can never be the smartest, shortest impulse wave. Wave 4 can never cross into the same price area as wave 1. As you have guessed, the key in using the Elliott wave theory in trading is all about being able to correctly identify waves. And by developing the right eye in recognizing what wave the market is in, you will be able to find out which side of the market to trade on, either long or short. There are three cardinal cannot be broken rules in labeling waves. So before you jump right into applying the Elliott wave theory to your trading, you must take your note of the rules below. Failing to label these waves correctly can be a bit disastrous to your account. All right, three cardinal rules of the Elliott wave theory. You have rule number 1, which is wave 3 can never be the shortest impulse wave. So you just take them all down. Then there are the guidelines that help you in correctly labeling waves, unlike three cardinal rules. These guidelines can be broken. Here they are. Conversely, sometimes when 5 does not move beyond the end of the wave 3, this is called truncation. Wave 5, more often than not, goes beyond or breaks through the trend line drawn off wave 3, parallel to the trend line connecting the start of wave 3 and wave 5. You know, waves 3 tend to be very long, sharp, and extended. Waves 2 and 4 frequently bounce off Fibonacci retracement levels, which are very, very important. Next page, please. Next page, please. How to trade Forex using Elliott waves. This is probably what you all have been waiting for, using the Elliott wave theory in Forex trading. In this section, we will look at some setups and apply our knowledge of Elliott wave to determine stop loss and a lot of things. So hypothetically, will most probably be the right scenario. And we are looking at take for instance, let's say you wanted to begin. You wanted to begin your own you have your chart and you cited wave one, which was the uptrend, and you see that the price seemed to have bottomed out and has begun a new move upwards. Using your knowledge of Elliott wave, you label this move up as wave one, the retracement as wave two, right? And in order to find a good entry point, you head back to the school of Pipsology to find out which of the three cardinal rules and guidelines you could apply. And here's what you find out. Rule number two, wave two can never go beyond the start of wave one. Waves 2 and 4 frequently bounce off Fibonacci retracement levels. So using your superior Elliott wave trading skills, you decide to open the Fibonacci tool to see if price is at that exact Fib level. And all of a sudden, you see that price is just hanging there and just like around 50% level. This could be the start of wave 3, which is a very strong buy signal. So let's say, for instance, since you're a smart Forex trader, you also take your stop into consideration. We have cardinal rule number 2, which states that wave 2 can never go beyond the start of wave 1. And so you set your stop loss below, way below the former lows. And if price retraces down to more than 100% of wave 1, then your wave count has been signified as a wrong one. So you're looking at a very important support there where you can place your stop loss. And then right after wave 1, you saw the uptrend, you saw the resistance. Then wave 2 was the retracement. And wave 3, you just mark it out with hope that that's the point where you need to start buying. So at wave 3 is the exact point you initiate your buy, or you make a buy trade execution and hoping the market, makes a lift off to that point where you want it to be. Next page, please. Now, the second scenario is this, it lets you use your knowledge on corrective wave pattern to grab those pips, and you're seeing a huge downside happening. You see a pullback, and it went down at 0.3, lower than 0.1, and started off with another resistance at 0.4 and pushed down. At that point, between 3, 4, 5, we can experience that momentum is gradually dying, and a retracement back to the top side, flat formation, beginning of wave 1 soon, is what is on every trader's mind at that point in time. So with that, you're marking out that very important support zone, and you're waiting for the push up to happen. So you begin counting the waves on a downtrend, and you notice that the ABC corrective waves are moving sideways. And is this a flat formation in the works? This means the price may just begin a new impulse wave once wave C ends. So we are seeing all these things, and we're looking at the up and downs. We're looking at the potential to sell, and it just gives you the idea of counting the waves on the downtrend, and you notice that the ABC corrective waves are moving sideways. Is this a flat formation in the works? This means the price may just begin in a new impulse wave once wave C obviously ends. Next page, please. Now, you're trusting your Elliott wave skills. You go ahead and sell at market in hopes of impulse wave. You place your stop just a couple of pips above the start of wave 4 just in case your wave count is wrong. And because we like happy endings, your trade idea works out and nets you a couple thousand pips on this day, which is not always the case. Now, you have also learned your lesson this time around, so you skip everything you have to do and decide to use your profits to grow your Forex trading capital instant. So you can see a very successful chart with proper analysis of the Elliott wave theory. And yeah, we talk about harmonic price patterns in Forex market too. Now, we have got the basic chart patterns down. It's time to move on and add some advanced tools. You have, we're looking at harmonic price patterns. And the whole idea of this pattern is that they help people spot possible retracement of recent trends. In fact, we'll make use of other tools we have already covered. Now, combining these wonderful tools to spot these harmonic price patterns will begin to distinguish possible areas for continuation of the overall trend. And in this lesson, we are going to discuss the following harmonic price patterns: ABCD pattern, tree drive pattern, Gartley pattern, crab pattern, bat pattern, and the butterfly pattern, my favorite. Then now, okay, the ABC and the tree drive pattern, let's just go with these two quick. So here's what it is. It could be more basic than the good old ABCs, but we'll just pop it in another letter at the end because we just want to have a full slate pattern. So we say ABCD chart pattern. And to spot this chart pattern, all you need is ultra sharp hawk eyes and a very handy Fibonacci tool. So for both the bullish and the bearish versions of the ABCD chart pattern, the lines AB and CD are known as legs, while BC is called the correction or the retracement. So if you use the Fibonacci retracement tool on leg, we have AB, the retracement BC, we should reach until the 0.618 level. And next, the line CD should be the 1.272 Fibonacci extension of BC. Next page, please. Wonderful. So all you have to do is to wait for that entire pattern to complete, reach the point D, as you saw before taking any short or long position. So you have bearish ABCD and bullish ABCD. Let's take bearish ABCD first. The length of line AB should be equal to the length of line CD. And of course, the time it takes for the price to go from A to B should be equal to the time it takes for the price to move from C to D. Easy peasy. So similarly, applies for the bullish pattern. The length of the line of line AB should be equal to the length of line CD. And the time it takes for the price to go from A to B should be equal to the time it takes for the price to move from C to D. So the tree drive pattern is a lot like the ABCD pattern, except that it has 3 legs, now known as drives, and 2 corrections or retracements, easy as ABC, because in fact this tree drive pattern is the ancestor of Elliott wave pattern. And as usual, you need a hawkish eyes, the Fibonacci tool, and a little smidge of patience on this one because it's a tree drive. So Take, for instance, you're seeing 1, 2, 3, AB, 1, 2, 3, AB, 1, 2, 3, bearish drive. So at the point where it hit the third point here, you're looking to sell. And at the point where it hits bullish drive 3, you're looking to buy. So as you can see from the chart above, point A should be the 61.8% of retracement of drive 1. Similarly, point that B should be this 0.618 retracement of drive 2, then drive 2 should be the 1.272 extension of correction A. And only, of course, by the time the whole 3 drive pattern is complete, that's when you can pull the trigger on your long or short trade. Because typically, when the price reaches point B, you can already set your short or long orders, at the 1.272 extension so that you won't miss out. But first, it would be better to check if these rules also hold. 1, the time it takes the price to complete the drive 2 should be equal to the time it takes to complete drive 3. And also the time to complete retracements A and B should be equal to understand that the price between them, between A and B, should have an intermittent movement to be able to know where the market is actually or purposefully heading to. So here's a forum thread discussing the ABCD pattern and a trade setup with a 3 drive pattern. Next page, please. Now, trading the Gartley pattern. There is someone called Harold McKinley Gartley, and he has a stock market advisory service in mid 1930s with huge following, and this service was one of the first to apply scientific and statistical methods to analyze the stock market behavior. Now, according to Gartley, he was finally able to solve 2 of the biggest problems of traders: what and when to buy. Soon enough, traders realized that these patterns could also be applied to other markets. And since then, various books, trading software, and other patterns have been made based on the Gartleys. Now, Gartley, also known as the 222 pattern, is named for the page number. It's found in H.M. Gartley's book, Profits in Stock Markets. Gartley's are patterns that include the basic ABCD pattern. We have already talked about that. And now, these patterns normally form when a correction of the overall trend is taking place and makes it look like M or W, and these patterns are used to help traders find good entry points to jump in on an overall trend. Now, we have the bullish Gartley, we have the bearish Gartley. A Gartley forms when the price action has been going on a recent uptrend or downtrend, but has started to show signs of a correction. Now, what makes the Gartley such a nice setup when it forms is the reversal points, a Fibonacci retracement, and Fibonacci extension level. This gives a stronger indication that the pair may actually reverse, and this pattern can be hard to spot, and once you do, it can get confusing when you pop up all those Fibonacci tools. The key to avoiding all the confusion is to take things one step at a time. In any case, the pattern contains a bullish or bearish ABCD pattern, but is preceded by a point that is beyond point D, the perfect Gartley pattern. Now we have move AB, which should be the 0.618 retracement of move XA from the chart, as you can see. And of course, move BC should be either 0.382 or 0.886 retracement of the move AB. And from what we can see, if the retracement of move BC is 0.382 of move AB, then CD should be 1.272 of move BC. Consequently, if move BC is 0.886 of move AB, then CD should extend 1.618 of move BC, and move CD should be 0.786 retracement of move XA. So it's just as basic as the case may be. Next page, please. Now, as time went by, popularity of Galdi's pattern grew, and people eventually came up with their own variations. For some odd reason, the discoverers of these variations decided to name them, and maybe they were part of the PETA. Without further, here's some of the packs. We have the crab, we have the bat. So the crab, basically, according to him, is most accurate among the harmonic patterns because of how extreme the potential reversal zones, sometimes called price beta reverse, and also how they move, because this pattern has a high risk reward to risk ratio, because you can put a very tight stop loss. And the perfect crab pattern must have the following aspects. One, which is the move AB from the diagram, should be 0.382 or 0.618 retracement of move XA. And move BC can be either 0.382 or 0.886 retracement of the move AB. And if the retracement of move BC is 0.382 of move AB, then CD should be 2.24 of the move BC. Consequently, if move BC is 0.886 of move AB, then CD should be 3.618 extension of the move BC, and move CD should be an extension of 1.618 extension of the move XA, just as the cases. Now, speaking of the BAT theory, around 2001, Scott Carney founded another harmonic price pattern called the BAT. And the BAT is way defined by the 0.886 retracement of move XA as potential reversal zone, and the BAT pattern retracement of BC is 0.382 of move AB, then CD should be 1.618 extension of move BC. Consequently, if move BC is 0.886 of move AB, then CD should be 0.2618 extension of move BC. CD also should be 0.886 retracement of the move XA. To the next page, please. Now we speak of the butterfly pattern. Like Muhammad Ali, if you spot this setup, you surely be swinging for some knockout size pips rather. And we're seeing a W pattern and an M pattern, bearish W butterfly pattern and bullish M butterfly pattern. So move AB should be at 0.786 retracement of move XA, and move BC can be either 0.382 or 0.886 retracement of move AB. And if the retracement of move BC is 0.382 of move AB, then CD should be 1.618 extension of move BC. And consequently, if move BC is 0.886 of move AB, then CD should extend to 2.618 of move BC, while CD should be about 1.27 or let's say 1.618 extension of move XA. So we have 3 steps in trading harmonic price patterns. Step 1 is locate a potential harmonic price pattern. Step 2 is measure the potential harmonic price pattern. Step 3 is buy or sell on the completion of the harmonic price pattern. And by following these 3 basic steps, you can find high probability setups that will help you grab those so lovely pips. Now, step one, you locate a potential harmonic price pattern. And of course, it looks like a potential harmonic price pattern at this point because in time we are not exactly sure what kind of pattern that it is. It looks like a tree driver. It could be a bat or a crab, and it could even be a moose, if any case may be. And let's just label it a reversal point. Let's just label it as that. The harmonic price patterns are totally reversal points. Next page, please. So we have harmonic price patterns. There are 6 harmonic price patterns. We have the ABCD pattern, we have the tree drive pattern, we have the Gatling pattern, we have the crab pattern, we have the bat pattern, we have the butterfly pattern. And the 3 basic steps in spotting harmonic price patterns are the following. Step 1, you locate a potential harmonic price pattern. Step 2, you measure the potential harmonic price patterns. While step 3, you buy or sell on the completion of the harmonic price pattern. Harmonic price patterns are so perfect that they are very difficult to spot. That's one thing about the harmonic price patterns. Next page, please. Divergences. Now, divergences are very important. You know, we used the tool MACD for this. And we have also tools like stochastic and the RSI and CCI as well. So if you're already in a long position and you could know ahead of the time the perfect place to exit instead of watching your unrealized gains vanish before your eyes because your trade reverses direction. And what if you believe a currency pair will continue to fall but would like to short at a better price or a less risky entry? Well, guess what? There is a way. It's called a divergence trading. And in a nutshell, divergence can be seen by comparing price action and the movement of an indicator. It doesn't really matter what indicator you use. You can use RSI, you can use the MACD, you can use the stochastic. And the great thing about divergence is that you can use them as a leading indicator. And after some practice, it's not too difficult to spot it out. So we should just think of divergences as higher highs and lower lows. Price and momentum normally move hand in hand like Hansel and Gretel. And if price is making higher highs, the oscillator should be making higher highs. If price is making lower lows, the oscillator should also be making lower lows. And if they're not, that means price and the oscillator are diverging from each other. And that's why it's called divergence. Divergence trading is an awesome tool to have in your toolbox because divergences signal to you that something fishy is going on and that you should pay closer attention. So using divergences trading can be useful in spot trading, a weakening trend or reversal in momentum, because sometimes you can even use it as a signal for a trend to continue. And there are 2 types of divergence. We have the regular, we have the hidden. The regular divergence is used as a possible sign for a trend reversal. And if price is making lower lows, but the oscillator is making higher lows, then it's considered to be regular bullish divergence. This normally occurs at the end of a downtrend. After establishing a second bottom, if the oscillator fails to make a new low, it is likely that the price will rise, as price and momentum are normally expected to move in line with each other. And below is an image that portrays regular bullish divergence. Next page, please. As you can see from the images above, the regular divergence is best and used when trying to pick tops and bottoms. You're looking for an area where price will stop and reverse, and the oscillator's signal is to us that momentum is starting to shift. And even though price has made a higher high, chances are that it won't be sustained. And now that you get a hold of regular divergence, it's time to move and learn about the second type of divergence, which is the hidden divergence. Now, the hidden divergences are not only signal a potential trend reversal, they also can be used as a possible sign for trend continuation. And the trend is your friend, of course, because whenever you get a signal that the trend will continue, then it's good for you, because hidden bullish divergence happens when price is making a higher low, but the oscillator is showing a lower low. And this can be seen when the pair is an uptrend, and once price makes a higher low, you look and see if the oscillator does the same, because if it doesn't, then it makes a lower low, then we have got some hidden divergence right on our hands. Now, lastly, we have the bearish diversion pattern filled with lower highs and a bit of higher highs. Of course, by now you have probably guessed that this occurs in a downtrend. When you see hidden bearish divergence, chances are that the pair will continue to shoot lower and continue the trend lower, downtrend lower. Now, let's have a recap what you have learned so far about divergence. One, if you're a trend follower, then you should dedicate some time to spot some hidden divergence. And if you happen to spot it, it can help you jump in the trend early. And of course, now you know about both regular and hidden divergences. We hope you got it all down, and you keep it in mind that regular divergences are possible signals for trend reversals, while hidden divergences signal trend combination. Next page, please. How to trade divergences. We'll show you some simple examples when there was a divergence between the price and the oscillator movements. Now, right below you have your oscillator movement, and as you can see from red lines crossing each other. Now, it was on a downtrend, but now potentially it was the downtrend coming to an end. We can see from the falling trend line that USD had been in a downtrend. However, there are signs that a downtrend will be coming to an end, while price has registered lower lows. The stochastic is showing a high low, and something looks the reversal coming to an end. Is it time to buy this pair? Then you would have found yourself in the middle of a Caribbean soaking up margaritas, and as you would have seen, knee deep is in your peep winnings. And it turns out that the divergence between the stochastic and good signal to buy, because price broke through the failing trend line and formed a new uptrend near the bottom. Of course, you could have made more than 1,000 pips as the pair continued to shoot even higher in the following months. And once again, you hop on the daily chart of USD. Now you're seeing a continuation downtrend platform, and then a brief higher highs and higher lows. And here we see that the pair has been in a downtrend, and we notice how the price formed the lower highs. Then just observe a little bit of the stochastic oscillator. You're seeing the red line and the blue lines sitting right on the very important resistance close to each other. but it finds it so difficult to make a push up. Next page, please. So technically, well, if you haven't been sure, you can understand this, that at that point, if you have decided to sit that one out, you might as well, have pulled out of some hair, and because the trend was not so healthy enough, price bounced from the trend line and eventually dropped about 2,000 pips thereabout. And imagine if you had spotted the divergence and seen that as a potential signal for a combination of the trend. Not only would you be, having some margaritas somewhere in the Caribbean, you would also be, having a road uh, road trip on a yacht to your preferred destination. So that's all for today, and that's all for Strategic Trader One. I believe we gained something insightful on Elliott wave theory, zigzag formation, and divergences. So it's very important for us to take these webinars very importantly, because um, they give us an upper hand when we have to flow better with the market, potential profitable entries and exit points, and know how to navigate successfully throughout the market. So that'll be all for today. I'll see you again next week.